Strong growth data cements rate hike bets in 2026 close of Hello everyone, and welcome back to the channel. Today, we're diving deep into some major economic shifts that are sending ripples through the financial world. The big headline? Stronger than expected growth data is solidifying bets for a potential rate hike in 2026. Let's break down what this means for you, for the markets, and for the global economy. Over the past few weeks, we've seen a series of economic reports that paint a picture of a surprisingly resilient economy. Consumer spending is up, the job market remains robust, and manufacturing output has beaten forecasts. While this is great news on the surface, it means the economy is humming along nicely. It also introduces a new set of challenges for central banks. Their primary mandate, after all, is to control inflation, and a red-hot economy can easily lead to rising prices. So, why are we suddenly talking about 2026? Central bankers, like the Federal Reserve, prefer to signal their intentions far in advance to avoid shocking the market. When they see persistent economic strength, they start to think about tapping the brakes to prevent overheating. This is done by raising interest rates. Higher rates make it more expensive for businesses to borrow and invest, and for consumers to take out loans for things like houses and cars. This cools down demand and, in theory, keeps inflation in check. The latest data has caused a significant shift in market expectations. Previously, many analysts believed the next cycle of rate hikes was a distant possibility, maybe not even on the horizon. Now, the probability of a rate hike by early 2026 has jumped significantly. We're seeing this reflected in the bond market, where yields on longer-term government bonds have started to creep up in anticipation of higher future rates. This is what traders mean when they say rate hike bets are being cemented or priced in. What does this mean for different asset classes? For stocks, it's a mixed bag. On one hand, a strong economy is good for corporate earnings. On the other hand, higher interest rates can make stocks less attractive compared to safer assets like bonds. Growth stocks, particularly in the tech sector, can be especially sensitive to rate hikes because their future earnings are discounted at a higher rate. We might see a rotation in the market, with investors favoring value stocks, companies that are more established and pay dividends, over high-growth names. For the housing market, this could signal a period of cooling. Mortgage rates are closely tied to the broader interest rate environment. If the central bank starts hiking, mortgage rates will likely follow, making homeownership more expensive for new buyers. This could slow down the rapid price appreciation we've seen in many regions over the past few years. If you're looking to buy a home, this is a trend you'll want to watch very closely. And what about your savings? Well, there's a silver lining here. Higher interest rates mean better returns on your savings accounts, CDs, and money market funds. For years, savers have earned next to nothing on their cash. A rising rate environment finally offers them a chance to earn a decent, low-risk return. It's a reminder of the fundamental push and pull in economics. What might be a headwind for borrowers can be a tailwind for savers. So what should you do? The key, as always, is not to panic. These are long-term trends we're talking about, and the situation is still evolving. 2026 is still some time away, and a lot can happen between now and then. The best strategy is to stay informed and ensure your investment portfolio is well diversified. Don't put all your eggs in one basket. Having a mix of stocks, bonds, and other assets can help you weather shifts in the economic climate. It's also a good time to review your budget and your debt. If you have variable rate loans, consider whether it makes sense to refinance into a fixed rate loan to lock in current rates. In conclusion, the strong economic data is a positive sign of resilience, but it comes with the very real prospect of higher interest rates down the road. The market is already adjusting to this new reality. By understanding the dynamics at play, you can make more informed financial decisions and position yourself for what's to come. That's all for today's deep dive. What are your thoughts on this? Do you think a rate hike in 2026 is a sure thing? Let me know in the comments below. Thanks for watching, and if you found this video helpful, be sure to hit that like button and subscribe for more financial insights. See you in the next one. Have you ever noticed those ugly water stains on your walls or ceiling after a heavy rain? Or maybe a musty smell in your basement that just won't go away? These are classic signs of water damage, a silent destroyer that can wreak havoc on your home's structure and your family's health. But don't worry, today we're going to dive deep into home waterproofing solutions to protect your biggest investment. Let's start from the ground up, the basement or foundation. This is where most water problems begin. One of the best exterior solutions is applying a waterproof membrane. Think of it like a super strong raincoat for your foundation walls. It's a thick, rubberized asphalt layer that's applied directly to the exterior of the foundation, completely blocking water from ever touching the concrete. Paired with a proper drainage system, like a French drain, this is the ultimate defense against basement leaks. Now, what if excavating around your foundation isn't an option? No problem. We can work from the inside. Interior waterproofing systems are also incredibly effective. This usually involves installing a drainage channel, sometimes called a water control system, along the inside perimeter of your basement floor. This channel collects any water that seeps through the walls and directs it to a sump pump. The sump pump then automatically pumps the water out and away from your house. It's a brilliant way to manage water without major exterior work. Let's move up to the main living areas and walls. Sometimes, water doesn't come from below, but straight through the walls, especially with porous materials like brick or stucco. This is where waterproof sealants and coatings come in. There are amazing, transparent, breathable sealers that you can apply to your exterior walls. They penetrate the surface and create an invisible barrier that repels water, preventing it from soaking in, all while allowing the wall to breathe so moisture doesn't get trapped inside. For interior walls, especially in bathrooms or kitchens, waterproof paint is a game changer. It creates a durable, mold-resistant finish that's easy to clean and stands up to constant humidity. Next, let's talk about one of the most critical areas, the roof. A leaky roof can cause damage throughout your entire home. Beyond just replacing missing shingles, consider applying a liquid roofing membrane. This is a seamless, fully adhered coating that can be rolled or sprayed onto your existing roof. It creates a monolithic, waterproof layer with no seams or joints for water to sneak through. It's flexible, durable, and can even reflect sunlight to help keep your home cooler, saving you money on energy bills. Finally, don't forget the small details that make a huge difference: windows and doors. Improperly sealed windows and doors are major entry points for rain. Regularly check the caulking around the frames. If it's cracked or peeling, scrape it off and apply a fresh bead of high-quality, exterior-grade silicone caulk. Also, make sure you have proper flashing installed above your windows and doors. This L-shaped piece of metal directs water away from the openings, preventing it from seeping into the wall cavity. Protecting your home from water is not a one-time fix, but an ongoing process of maintenance. By understanding these solutions, you can choose the right approach for your home and keep it safe, dry, and healthy for years to come. What waterproofing challenges are you facing? Let me know in the comments below. Thanks for watching, and don't forget to like and subscribe for more home improvement tips. Hey everyone, and welcome back to the channel. Today, we're diving deep into some major economic news and breaking down exactly what it means for you, whether you're a homeowner, a potential buyer, or a real estate investor. We've just seen some incredibly strong economic growth data come out, and the big headline is that it's solidifying expectations for an interest rate hike, but probably not until 2026. So what's the real story here? Let's unpack it. First off, what does strong growth data even mean? Essentially, it means the economy is doing better than expected. More jobs are being created, businesses are investing, and people are spending. On the surface, this is fantastic news. A healthy economy is good for everyone. It often leads to higher wages and more financial stability, which can boost confidence in the housing market. When people feel secure in their jobs, they're more likely to make big purchases, like a new home. This increased demand typically pushes home prices up, which is great if you're a current homeowner looking at your equity. However, there's another side to this coin. A booming economy can also lead to inflation. That's when the prices for goods and services start to rise across the board. To keep inflation in check and prevent the economy from overheating, central banks, like the Federal Reserve, use their most powerful tool: raising interest rates. Higher interest rates make borrowing money more expensive. This cools down spending and investment, including in the real estate market. When mortgage rates go up, it costs more each month to own a home, which can sideline some potential buyers and slow down price growth. So, here's the crucial part: the timeline. The latest data is pointing towards a potential rate hike, but the consensus is that it won't happen until 2026. This gives us a unique window of opportunity. We're in a bit of a sweet spot right now. We have a strong economy boosting confidence in property values, but the anticipated rise in borrowing costs is still on the horizon. It's like seeing storm clouds gathering in the distance. You know the rain is coming, but you have time to prepare. What does this mean for your real estate strategy over the next year and a half? If you're thinking of buying a home, this period before 2026 could be a prime time to act. You might be able to lock in a mortgage at a relatively lower rate before they start to climb. Securing a fixed-rate mortgage now could save you a significant amount of money over the life of your loan compared to waiting until rates are higher. Of course, this doesn't mean you should rush into a decision. It's still essential to make sure you're financially ready, have a solid down payment, and find a property that truly fits your needs. For current homeowners, especially those with an adjustable rate mortgage or a high-interest home equity line of credit, now is the perfect time to consider refinancing. Locking in a lower, fixed rate could protect you from future rate increases and provide more predictable monthly payments. It's also a good time to think about your long-term plans. With property values likely to remain strong in the near term, you might have more equity than you realize. This could be leveraged for renovations or other investments. And for the investors out there, this forecast provides clarity. The period leading up to 2026 might be ideal for acquiring new properties before financing becomes more expensive. A strong economy often means a strong rental market as well. As you plan your acquisitions, factor in the potential for higher interest rates down the line and how that will affect your cash flow and long-term returns. The key is to stress test your investments against future rate scenarios. In summary, this strong economic data is a double-edged sword for real estate. It signals a healthy market in the short term, but hints at higher borrowing costs in the future. The key takeaway is that we have a window of time, until about 2026, to make strategic moves. Whether you're buying, selling, or investing, being aware of this economic forecast allows you to plan ahead and position yourself for success. Thanks so much for watching. I hope this breakdown was helpful for you. If you got value from this video, please hit that like button and subscribe for more real estate insights. Let me know your thoughts in the comments below. See you next time.